Hello, welcome once again to Phoenixville Public Library. Tonight we go into the breach one more time with Christian Weirich of Creative Capital Wealth Management Group in our finance and investment series, delving into a very interesting, possibly eye-opening topic tonight of alternative investment basics. Christian, welcome back, and again, take it away.
Appreciate it. Thanks. Good evening, everybody. It's again, it's a joy to be here, get a chance to talk about finances and investing. Appreciate the audience. What we want to cover today, and we'll get into it, is what is alternative investments. As Mark mentioned, my name is Christian Weirich. I'm the Senior Wealth Strategist at Creative Capital Wealth Management Group in Chester Springs. Our founder, Fred Hubler, is an advocate for this level of community conversation, and so I was happy to participate this year. This is the third conversation in our series of three. We covered the fundamentals in our first conversation, and to quickly review, that is make sure that you've got a good budget, that you stick to your budget, review it often. Debt, bad debt, and eventually good debt is something that you want to be conscious of and manage. Last time we were together, it was about the basics of investing in the stocks and bonds, the public markets that we talked about. Talked about the broad array of various markets to invest in, types of products, what does that mean, the different ways that they are packaged, and then looking at what's the approach to financial investing, how do you go about doing that, what are your goals and objectives. Tonight, this evening, we wanted to get into and cover the area that is popular. It's certainly increasing in popularity. It's been around for a while, a long time. If technically you want to think about the Transcontinental Railroad was a private investment. So the concept of private investments have been around for a very long time, 1853. The actual modern version of alternative investments are something that has been developing for a long time, and I would position this as, we'll cover this. What are alternative investments, and how are alternative investments important to an investment portfolio? Simplest terms, alternative investments are investments in products or opportunities that are not in the public markets, okay? Public markets, stocks and bonds. The stock market, New York Stock Exchange, if you want to buy orange juice futures, the Chicago Commodities Board Exchange, it is the Vanguards, the Merrill Lynches of the world. It is stocks, bonds, mutual funds, ETFs. It is investing monies in either owning pieces of companies, stocks, lending money out, bonds, whether you're lending to corporations or you're lending to the government, or some variation of those two things, right? Mutual funds, which have been around for a very long time, ETFs, that's the public markets. What is the inside of that stuff is listed on public exchanges. Alternative investments delves into the world of private investments, right? So it is similar structures, which we'll talk about, similar areas where you can make those investments, but for all intents and purposes, they are private opportunities. When we look at the public markets, to put this in context, there are about 3,200 publicly traded companies that make up the various exchanges. Across the United States, there's about 3,200 public companies of various sizes. The largest companies in the world to much, much, much smaller companies, but they are publicly traded. They come with their own obligations for disclosure, responsibility, reporting, etc. Contrast that with the private markets. There are millions of private companies from various sizes. They just simply have made decisions to either they're not able to go public or they choose not to go public. But they are corporations nonetheless. They are still looking for opportunities to grow their revenues. They are still looking for opportunities to bring in new capital to fund and allow them to grow and expand whatever their goals are as a corporation. Okay, so that allows for us, the investors, to figure out a way to get involved with these private opportunities. What do we do? There's some bars of entry, some hurdles of entry that we have to get over as investors that want to invest in these private opportunities, right? They are typically, traditionally, the realm of endowments, foundations. The sort of example that people point to as the quickest reference is the Yale endowment, Yale University, right? Or Harvard. Here's a pool of money that these institutions have accumulated. They want this pool of money to do something. They just don't want it to sit there in cash doing nothing. So they make these investments. Well, they would quickly sort of run out of opportunity and start exposing themselves too much to public investment risk, right? If all of this money, and it's a lot of money that they have, was allocated to the stock market or bonds, they would eventually run into a risk problem. There's too much concentration in public markets, too much concentration in just bonds. Where else? And that starts this access to alternative investments, this conversation. Where else can we look? And it leads us to these private companies. Private corporations leads us to private lending, leads us to real estate, and the various public and private opportunities to invest in a multitude and styles of real estate. It also leads us into, and we'll get into this later, other areas of investments. Okay, well, those large foundations, those large endowments have access to this. What about individuals? Government says, well, you can have access to this stuff, but fair warning, there are different rules for disclosure, risk. The burden of your investigation is more on you, and we want to limit the exposure to the public. What we would like to avoid is people who may not understand and can afford this level of potential risk, being a private investment. So we're going to put in requirements of certain level of assets or certain level of demonstration of income that would put you in a category of sophisticated, whether you actually are or are not. If you have the income or the accumulated assets, the government designates you as being a sophisticated investor, and the responsibility, buyer beware, falls on you, the specific investor or the team that you're working with. So that's the world of alternative investments, right? It's putting us in a space that most individuals don't have access to. It puts us in a space where large institutions are comfortable in being in. They recognize we're comfortable with whatever the various risks may be because our timeline is much longer than the average individual or the couple that's investing for retirement. These institutions are, in essence, in perpetuity. So their measurement of risk is vastly different than you or I. And what they're also looking for is a way to diversify investments and risk exposure. Give us different ways that our money can work for us, that is away from public markets and the volatility inherent in public markets. Private lending, private investments in corporations called private equity. All of these very interesting areas, which is something that I've really enjoyed learning about, give us a chance to have diversity in our risk exposure, right? Part of regular traditional investments, don't put all of your investments into one company. It may be a really good company. Someone might shout out, NVIDIA was, over the last 5 years, a fantastic company. And if you'd stuck with just NVIDIA the last 2 weeks, you would be upset because it was a precipitous drop, which is what stocks do, right? Okay, so alternative investments give us a chance to have a different kind of risk than public investments, right? It's important to make the distinction. It's a different exposure to risk. It's a different kind of risk to our investments. It is not an absence of risk, okay? It is still investing in corporations, as the case may be. It still is investing in real estate. Real estate is cyclical. It is still an investment, so we have the volatility that is required for that investment to have a high rate of return, or if it's a very secure, conservative investment, a lower rate of return. Those rules of money still apply to alternatives. It's simply a different type of risk. And as an investment strategy, alternative investments, what's important to investment portfolio, the key goal is to help diversify the risks that your money is being exposed to. That diversity can be measured in what we call correlation. If the stock market goes up, does the performance of these alternative investments react to that? Are they tied to that performance? Or do they go in the opposite? Do they go with it? Are they in lockstep? Or, as the value of alternative investments, they have a low correlation. Whatever the stock market does, it goes up, it goes down. The idea is a lot of these alternative investments aren't impacted. They're doing their own thing. So it allows for an investment portfolio, your money that you're investing, to have different ways of growing that aren't connected to simply NVIDIA or the stock market, right? Or technology companies, whatever the case may be. It's that diversification is the goal. That's the investment goal that we encourage and try to work with our clients. So let's get into a review of a couple of these areas of alternative investments. Okay, what do they look like? One area is real estate. So the different types of real estate, there's a way of holding real estate where you purchase it. Your primary residence is an example of real estate investing. Your home. It's your home, it's your residence, and it's part of your investment portfolio. It's traditionally something that isn't invested in because you're looking to sell it in 6 months if the real estate market in your area spikes. It's more of a long-term, it happens to go up in value, but that value will fluctuate, and at some point you may sell that property and there could be a gain in the value of your home. And you maintain it, you do additions to it, renovations, it's where you live, but your residential home is an example of a real estate investment, and it's yours, so it's a good example of a private real estate investment. What else can you invest in? Almost any other real estate that you can think of as an opportunity, there's some version in a product or package in a private opportunity, okay? So private investments, alternative investments in real estate could be focused on commercial buildings, office buildings, multi-family apartment unit complexes, warehouse spaces, storage spaces. What else have we come across? A collection of investment properties that are focused on student housing around universities. Okay? So there are individuals who are real estate people that own a portfolio of investment real estate positions, right? Some are very large, some are just your neighbors, and they own their house, they've got a shore house, maybe they've got a couple rental units. I have a neighbor who, he and his wife, he's a real estate agent. His goal is to build a portfolio of investments in real estate that generate an income to him and his wife. And he is attempting to create a collection, a portfolio of real estate investments that provide a passive income, mostly in rents, people paying rents in their apartment, that will be the main source of their income for each year, right? What else? Corporations are willing to not own real estate sometimes. So an example of this is Amazon. Amazon is one of the biggest, and they will have a operations delivery, you know, the Amazon warehouses. Amazon makes a decision, we don't want to own all these warehouses. We need warehouses. We will lease the space to use them as our warehouses, but we don't want to own the real estate because all of the potential challenges of owning that much real estate. Excellent. Other companies are more than happy to buy those warehouse spaces. We will own them and we will lease them to you, and you will pay us rent. You're responsible for upkeep, but we essentially own the property. Well, those real estate holding companies are looking for people that can give them some additional capital, mainly investors, and that allows for these real estate companies to buy more warehouses. And so there are investment opportunities that are designed around, we own and lease to Amazon these warehouse spaces. And there's an income from the lease payments that Amazon makes. So there's direct investments, there's these real estate investment trusts, we call them REITs, and that's this, like a mutual fund of real estate, right? This collection, this basket of various investments that will, typically real estate investments, you're doing it for the income being taken from that property and distributed to you, the investor. And DSTs, Delaware Statutory Trust, is a type of real estate transaction. In the IRS code, it is a 1031 transaction. It allows for you, the real estate owner of a property, a landlord. I no longer want to be the landlord. I'm going to sell my building. Great. You've sold your building. Congratulations. You also make the statement, I don't necessarily want to pay taxes on that either. IRS says, well, okay, you're allowed to make that transaction and avoid paying taxes if you do it according to this very strict set of rules. And that is the legal structure called a Delaware Statutory Trust. And essentially, I'm selling my property. I'm going to become owner of a basket of properties, or maybe it's a different, I'm a part owner of a specific complex. A great example is Riverworks, the new multi-family apartment complex. Not one company owns that in the sense that Cantor Fitzgerald, the company, bought the property, but they asked for investors to add additional capital. So if you use the DST structure, you could have sold your apartment building, put your money into this DST structure that Cantor Fitzgerald organized, and you're a part owner, a very small percentage owner of Riverworks. There's some income that you derive from that, and while it's in that structure, the IRS allows you to not pay taxes on that money. Okay? So it's a way for an investor to delay paying taxes on an investment. That's another aspect of real estate investing and alternatives. Okay, benefits and risks. What are the potential benefits? We just talked about that. I'm able to make an investment from a real estate transaction I did. I'm avoiding paying taxes on that for the time being. Potentially, if I continue to just keep rolling it as those investments mature, and and I just keep rolling it, and then I pass away, my heirs will get the new value upon my death, and essentially this pile of money has not paid taxes. Right? So it's a tax management strategy. What are the potential risks, though? Potential risks, just like all of us that are investing in real estate moves in cycles. What we saw in 2021, 22, 23, when interest rates spiked up, if you owned real estate and you were responsible for reporting your holdings, meaning you weren't just a private real estate holder, it's just not my apartment building that I own, but I'm a corporation, I'm a company, and I have these products, you had to value your portfolio based on this new higher interest rates. And you know, in real estate, if the amount of interest rate goes up, that makes it more expensive. That means the value of the property goes down. So in 2023, 2024, if you own real estate privately in some of these alternative investments, your value of your investment has gone down. Nothing's wrong with the building, nothing changed in the property. If it was a rental multi-unit investment, still everybody's paying rent, nothing's wrong, but there was an obligation that we have to value this portfolio at these new higher interest rates. Well, that's a risk that you're investing in those private real estate investments. Let's talk about a different alternative investment opportunity. Oil and gas. Oil and gas, oil and natural gas. Gas means natural gas. Again, an opportunity for individuals to invest in private opportunities, private products that deal in drilling, bringing oil out of the ground. You could, in a public market, buy Texaco, buy Chevron, buy Sunoco, you could buy stocks of these very large gas producers, or there are opportunities privately for the direct participation in oil and gas drilling, oil drilling and natural gas drilling. I'll give you an example. Western Pennsylvania, there's a company that drills natural gas wells. We've got a large world economic market for natural gas. And you can see in the news various countries around the world leverage their ability to provide natural gas to other countries for good or ill. The United States is also looking for energy independence. So there's a demand and a growing demand for natural gas. And it burns cleaner than oil. Okay. Well, that costs money to get the natural gas out of the ground. Companies that are designed and built to be drillers will come to investors to say, hey, if you give us capital, give us your money to invest, helps us build and produce natural gas, we give you part of the profits that we get from selling natural gas. Pretty straightforward. There are tax benefits also to this. So you become, not to get too deep in the weeds on it, you become a partner in these investments where the company is going out, putting a hole in the ground, extracting natural gas, taking it to market, processing it, taking it to market. You get a piece of those benefits. You get an income derived from that. There can be, based on how the government structured drilling tax issues back in the 40s, essentially, if you're participating in this company, you're giving them some capital, you can take a tax credit. Now, it's not a tax credit, it is a income offset deduction based on it costs money to build the wells, and they are indirect drilling costs, IDCs. And so you're getting a tax benefit for giving them your money. They'll also provide you with a stated income goal, which tends to be higher than a typical CD at a bank or a bond, right? So for the risk of, I'm investing in the oil and gas industry, I'm going to have a return on my money that's higher than if I just simply bought a government bond, right? So that's oil and gas. And there's numerous iterations of this, different stories, different companies, very large public companies, very large private companies that are, some of the largest private companies in the country. One of them is a driller. In Texas, they're drilling oil. There's lots of different stories, different areas of the country. Texas, there's the Texas shale, a couple areas in Texas, North Dakota. Natural gas happens to be Western Pennsylvania, happens to be very plentiful in natural gas, really driver of the market. So that's a whole world of private access that we are exposed to, we're used to seeing. I go to the gas station and fill up. I don't really think about it. Many of us just fill up our cars and drive around. Well, there's a whole economy attached to the back of that. I turn my stove on in my house, natural gas. But if I'm so inclined and I vet out that opportunity, I can participate in earning an income off that natural gas. Let's move on to some additional private investment, alternative investment. Here's the stuff that's cool. Private equity, private credit, right? I referred at the beginning of our conversation about the endowments, the Yale University, Harvard University. What are they investing in? Private equity, private credit, those private corporations, they need capital infusion investments in them just as well as Amazon does or Apple does when they offer up their stocks to the public. There's a broad array of ways to be involved in private equity and private credit, which is private lending. There's numerous, hundreds, thousands of various products and packages that you could invest your money in. Big picture, private equity, there is certainly a reputation in private equity in the last 10 years, 15 years, a negative reputation where they've come in and they sort of approach a corporate entity and say, okay, bottom line, we're cutting jobs, we're cutting expenses, we're going to maximize the value of this, and then we're going to flip this company. That has happened, that is true, and in the broad array of private equity, that's a relatively minor representation of what it does. A lot of what it does is participate, support, work alongside of these private corporations to grow and generate more revenues. It's adding capital where needed. The funds of funds, venture capital, the structures. How do we invest in this? One way to do it is simply identify a company, a private company. Can I become an investor in your company? Yes, no. That's a direct investment. Hard to do, hard to identify, hard to do all of your research. There are professional companies that are looking for these investment opportunities on your behalf, and there's famous large companies. The Blackstones of the world is an example of a famous large company. KKR is another name that is popular and well known. There's approaches that are very sophisticated, very high end, that require you essentially to commit. I will commit a very large amount of money, and then over the course of the next 7 years, as you find these opportunities, you come tell me how much money I got to give you out of this commitment I made. That would be an example of the traditional private equity approach. I call it the old school approach. Now, much more user-friendly for investors, much more variety in the structures. It could look like what mutual funds look like, what ETF packaged products look like. And that gets us into the fund of funds, where we're in the space of private companies looking for investments. They are certainly available to invest in and consider very niche stories where they're packaging up one story that we like and we share with clients, opportunities where there's a company out there and they're looking for franchisees who are retiring in very specific fast food franchises. It's called quick service, by the way. And so they're identifying, here are these owners, they're retiring, they're looking to sell their assets, sell the franchises, they no longer want to manage them. This company comes in, we'll buy your stores, we'll apply our upgrades in terms of supply chain and leadership and opportunities to develop the employees, and we'll ask for supporters to support us as we go out and buy more of these stores. We're building a portfolio of better performing fast food chain stores. Eventually, they'll put this portfolio of stores, maybe 100 or a couple hundred of these various stores in various chains, and some very large corporation that deals in private investments, like rhymes with Blackstone or KKR, will come along and pay us for it. Because you, the investor, were involved, you put your money in, we'll give you a return for that money, and then when we sell the portfolio, we'll also give you part of that equity experience, right? So that's the goal of private equity. Private credit is private lending. There's a builder in Texas. They were of a size where they got frustrated with dealing with the banks to try to manage their loans and the leverage that they needed. They were sufficiently large enough that they created their own bank, was what they did. So they're accepting loans, you're investing with them, and for that investment direct with them, they will guarantee and promise a specific rate of return, right? So it is a company, it's a broad company, they do a lot of development, but it is in Texas, they're building homes and communities in Texas. You're lending your money to them for a course of time, and they promise a rate of return. Private lending. And then there's also, larger versions, private lending mutual funds, right? It's a company that is collecting these different opportunities, or they're doing a lot of lending with their pool of money to private companies, and you can add your money to that pool that they're lending out, and there's a rate of return that those private companies promise to pay back. Right? It allows for them to sort of get around going to banks to get financing, right? Because the banks are here to make money too. The banks might be charging rates of interest that are higher than these private companies want to pay, and so they'll go to private lending because it's still a large rate of return, but it's cheaper than having to deal with a bank. Yeah, question?
How does government regulation fit into that?
So, there's government regulation to the degree of the corporations and the companies that are involved in these transactions have an obligation for reporting to the degree that they do. There is some oversight on the actual investments, like what are you doing, and share with us the books, share with us what you're doing. And there's an obligation of due diligence and disclosure by these companies that are doing the private lending. and if they're asking for us to participate as investors, there's a reporting obligation that they have to share with us, quarterly, annually. So there's a very similar sense in terms of comparing it to a publicly traded company that's working on the stock market or doing bonds. And it's not as, well, it's regulated by different authorities, right? SEC, Securities Exchange Commission, regulating those public markets, all of their rules. Private alternative investments don't necessarily have the same government entities, but there are government regulators involved. But it's not like the SEC, right? Okay, so benefits and risks. Benefits, you're able to have this experience with your investments in private equities and private credit where the return on your money is similar to if you, or sometimes better than if you had invested it in the stock market. That's a great benefit. I love that idea. That's great, let's do that. What's the risk? The risk is you're investing in something that has risk to it. If the company that's investing in these franchises, in quick service restaurants, people decide, I don't like that. I don't like that chicken. And their revenues drop, well, then your experience as an investor is going to be negatively impacted, right? So there still are the risks of these investments. What we're trying to accomplish is marrying them with public investments, and we're looking at the mixture of those risks to not be in connection with each other, low correlation, diversify of our risk. So let's talk about that, right? Let's address those questions. So what is the importance of a diversified portfolio beyond just simply a diversity of stocks and bonds, large companies, small companies, government bonds, corporate bonds, right? What are some of the traditional portfolio risks that we're trying to address? Inflation, duration, credit, the concentration in a public portfolio, leverage, the various traditional portfolio risks. Having a diversified portfolio that includes alternative investments can help mitigate some of those factors. They can add to lessening the volatility. It might help protect with if there's some volatility around. There may be politics, or people are yelling at each other on cable news in Washington D.C. in politics. It helps protect against event risk, like NVIDIA. What's wrong with NVIDIA? I don't know, probably not much, but for the moment, the stock market doesn't like NVIDIA. It also can help us diversify and insulate our portfolios from some of those economic downturns, those economic risks. And it also allows for a bit of this diversity for our own behavioral risks, right? That concept of loss aversion, or all of us are human, all of us struggle with the recency bias, hindsight bias. Oh, if I'd only have bought, if I'd only sold it. Well, let's have a well-diversified portfolio. That diversity into these alternative market spaces, though, still have their own risks. This is not all the benefits with none of the bad stuff. So if this is a consideration, and I think it should be for everybody that's able to look at alternative investments, there is still this, again, barriers to entry. Not everybody can participate in private investments. There can be a lack of disclosure, to your point. Who's watching these people? Sometimes nobody, right? Does it happen often? No, it doesn't happen often. There's still market forces, there's still obligations, but it does happen. There was a driller in Texas the last couple of years, took in investment, private money, promised and set up, we're going to drill for oil. They did. There was oil there. They were pulling it up out of the ground, but this particular driller decided they don't want to pay for the pipe that went from their field to the main pipe. And the company that built that pipe for them wasn't getting paid. Well, we did the work. You owe us the money. How come we're not getting paid? And so took that driller to court. That driller wound up having to file bankruptcy papers and go through that process. They're working it out. There is revenue there to pay the, not only pay the contractor, but also to pay the investors. But there was a moment there where, who's paying attention to this person? Why weren't you guys paying your bills? What happened? So there is sometimes a lack of disclosure and due diligence. Have to be aware of that. Restricted liquidity. A lot of these investments, you're going to be making a commitment. I'm promising you to lend you or to invest with you for a period of 5 years is a frequent amount of time. It could be longer, it could be shorter. But many of these investments will require you to be comfortable with this money is going to go away, it's going to be invested, it will perform, but I will not be able to access it if I need to do something else. If all of a sudden the car needs to be repaired or I got to fix the house, it will not be this money because this money is obligated and locked into this investment for 3 years, 5 years, 7 years. So again, planning, making those decisions, understanding the dynamics of your portfolio and what your goals are. Misunderstood risks, again, goes back to understanding because it has a low correlation to the stock market does not mean it will never go down, right? And some people sort of get it in their head, they're like, how come it went down? Well, you know, various factors. There's still event risk, and the other higher correlation is that sense of we were expecting it to not work in conjunction with or perform with the stock market. Sometimes it does. So it's not a risk-free approach to investing. It's simply changing, diversifying, modifying the risks that you put into your portfolio. With that, I'll also summarize it goes back to with financial planning and your investment portfolio and the goals that you have, coordinating, having a conversation, understanding what your objectives are, understanding what the plan that you're trying to put in place is there to accomplish. How do you balance the risks available so that to your understanding with your risk tolerance? The investment itself could be perfectly fine, could be for most people a suitable level of risk, but if your personal relationship with risk and money and your experiences as a child has that influence on your attitude towards how your parents dealt with money is an influence, and you're not able to be comfortable with that. And I've had these conversations with clients. They had an extraordinary amount of money, but that mindset was, I need it in cash. I cannot risk it just even a little bit. My brain won't let me. Okay, this is completely not appropriate for you. We're not going to have any of these conversations. You're not investing in any of these alternative investments because your mindset won't allow you. So that idea of tying this in, it's just more diversification, more broader exposure for other ways for your money to work for you to help you with your 2, 3, or 4 most important objectives or goals in your life, right? The investment portfolio, the investment conversation, my belief is, should always be tied with what are we asking for this money to do, what's your objective, what are your goals, what's your dream, and how can the money help you get there. So it's all tied into legacy, lifestyle, retirement, whatever those goals are, investments should always be supportive of what you're trying to accomplish. Questions? I know we don't have any questions online this evening.
We don't, no.
I guess I do have one. I'm
Sure.
sort of trying to process some of the stuff that you said, but I just
Yeah.
want to be clear on something regarding private equity. And that is that the government is the one that's limiting access to it based on a person's wealth. Is that what I heard you say?
Yeah, that's the main driver, and there's a bit of mutual exclusivity,
Okay,
right?
yeah.
So the government is saying, hey, we don't want just anybody who may not be a sophisticated investor
Right.
to have access to this stuff because it's a bit next level. And so we want to put some parameters on who would be allowed to make these investments. Now, whether they do or don't, that's a choice, but who is able to have access to this information, it's a bit restricted. Because again, the perceived nature of these investment opportunities is, this is sort of next level stuff. And the companies that are organizing and offering these opportunities, they themselves recognize, like, what we're doing here is not just, buying indexed for the stock market. Vanguards, you could just buy an index fund and have exposure and performance of the stock market, which everybody should have, for their retirement investment exposure to. Great. But the companies that are involved in building and crafting and offering these products, they themselves also want to be like, we want people that are participating with us to, be experienced, have a little more sophistication. So it's a bit of both, right? The government's like, make sure who you're talking to is able to understand what you guys are offering, because it's not as regulated, and the companies themselves self-regulating or being like, yeah, we're not here to just offer it to everybody. Does that make sense?
No, perfect sense.
Yes, okay.
I guess I'm mentally trying to conceptualize all this, and I'd always thought it was sort of, you were privately excluded based on some mysterious club out there of rich people. I didn't know the government actually had a say in the matter. That surprised me.
Yeah.
So.
There certainly is a tradition, an aura around some of this investment of oh, this is backroom stuff at the country club that no one has access to. It's a bit of that, yeah, because traditionally in our history, the people that had portfolios to invest were usually a higher socioeconomic level, and then to go to even that next level of private investments, it gets into a very exclusive set of a certain economic level. So yeah, there was this, I don't think I'll ever have access to that stuff. What has happened though, in the last 25 years, is that democratization of access, right? This broader diversity, this demand in the marketplace for access to these private companies, access to these private lending opportunities, and the recognition by the market, right? Adam Smith's invisible hand, where there's a demand, we're figuring out a way to meet that demand. And so the ability for a broader array of well-off investors, that's broadening to the point where it can now be considered part of a good allocated portfolio. It's moving beyond just stocks and bonds, right? Like I was saying earlier, it is now, okay, you don't get one of everything, but what would be appropriate? What additional investment could help? change the risk of your investments, could help mitigate some of that. What else could we look at for an income source? Well, we could buy stocks and bonds. Bonds go through their own cycles, right? Interest rates impact that. Maybe there's some private lending opportunities. Well, what's that rate of return? Well, it's better than, it's certainly better than CDs that banks are offering, right? It's this additional areas of access that we can have access to. Said that we're doing.
I still have some questions. Is that
Yeah,
okay?
please.
Yeah.
Because you talked about democratization. Two questions come to mind. First is, so what about the average investor? Like, and so I want to give like a concrete hypothetical. Suppose you were talking about, hindsight or something, but supposing 5 or 10 years ago I had bumped into Sam Altman, and I thought, I think he's, or something AI related, and I think this is really where I want to put my money.
Yeah.
I'm not rich,
Yeah.
but I think it's going to take off.
Right.
I can't do that. Is that correct? Unless I have a certain amount of capital myself?
Historically, that would be a very accurate statement,
Okay.
right? And to my point, that democratization of access. Now, because there is that demand, if you meet these levels of whether it's income or assets, net worth is sort of the measurement that they have. There are now private mutual funds, for lack of a better term to explain what they are. It's a fund, it's a mutual fund. And there's one in particular where their theme, their objective is to go out and build a basket of those companies that are private now, that are on the verge of going public. So there's this opportunity where once you go public, there's sort of that initial pop, and everyone's like, oh, this is the greatest thing ever. And then, the cycle of going public, there's a pop, everybody thinks this is great, there's a drop, and then the market sort of says, okay, what do you really have? Krispy Kreme's is an example of, oh, this is the greatest, everybody loves donuts, and then it comes out publicly, and everyone's like, I can't eat donuts all the time, and it sort of finds its level. Okay. To your point, AI technologies or SpaceX is sort of the buzzy idea right now where everybody's talking about it. How do you get, unless you're a billionaire, I guess you just can't get access to SpaceX or some of these AI companies. Not true. Again, here's a private mutual fund that is offering access to these companies as part of this basket that they've built. Something like a SpaceX might represent 10% of this basket. And we can invest some money as low as $2,500 to be, again, like a mutual fund. I own some shares in this product, this mutual fund. It happens to be a private mutual fund that is concentrating on looking for and getting access to shares of these companies right before they go public. Now, would you invest all of your 401k in that? No. Right? That would be a bad idea. Could you invest some of your retirement funds? Maybe, yeah.
And then that leads to my second question. I guess I know the answer now that I'm saying it out loud, but how does the average investor find out about these private funds? And I guess it would be through someone like you,
Yeah.
I guess.
Yeah, and again, the breadth of information and access is expanding quickly. So if we were to look at traditional large brokerage firms, Merrill Lynch's, Wells Fargo's, UBS's, sort of the big names that advertise on television. There is some access that they will allow their advisors to have to certain areas of this alternative world, but they'll be very conservative about who's allowed or which clients or which advisors. They're very strict about it. When you're in an independent space, you're a broker-dealer, you're legitimate, but you're not one of the big companies. You're, in my case, working with Creative Capital, we're a registered investment advisor. We're an independent. The founder, Fred, he's the boss. We have an interest in a lot of this. We recognize, and part of our work with our clients is to bring these ideas to the table. We see value in it. It's a lot of paperwork sometimes. It can be very complex. It's very sophisticated, and we still see value in it. We still see it as an important part of the conversation. So, absolutely, the average investor probably doesn't have access to it inside of their company 401k,
Exactly.
right? The company 401k, we are here to provide you the responsibility of picking stocks and bonds and your mixture. Pensions are a thing of the past. Corporate obligation to paying you for the rest of your life when you're in retirement. Companies figured out that's expensive. We're not doing that anymore. Here's 401k. You're responsible for it. And for now, it will be changing, but for now, the menu you get to choose from in your company's 401k is very, like, you can get large companies, small companies, stocks, bonds, a mix, the general index. We can sort of build it so that we're getting more conservative as you get closer to retirement, right? Very traditional investments, which is fine, that's fine. The rate of participation for working Americans in their 401ks needs to go up anyway. Like, you got to protect yourself. You got to do your own retirement planning. But just the broadening of access to the alternative investment world is increasing at such a speed that if we were to look at the 401k offerings over the next 5 years or so, they're going to start diversifying. They're going to start off, right, that model, sort of the touchstone, the Rosetta Stone of alternative investing, the Yale and Harvard endowment approach, kind of is the basis where this broad acceptance of alternative investments is coming out of, right? If Yale can do it, right, and when you look at their performance, that's really the key. Their returns, how their money works for them over the last 40 years.
Right.
You look at that performance, that's where everybody's like, wait a minute, what are you guys doing? What's happening, right? The stock market had a bad year last year, and it was down, but you were up. How'd you do that? And that was when people started to tinker around and figure out, what are they doing? And there's this exposure, these investments in these private companies, private lending. So that is sort of the door that got unlocked, and now it's becoming more and more mainstream.
Yeah, you said some great things, and you made me laugh because you made me realize there's more than myself out there. Because I remember years ago thinking, why don't I look at Harvard's trust? Because whoever's managing that must be brilliant, and just copy it. I can't.
Yeah.
But now I'm realizing in the future, there might be more opportunities.
Yeah.
Because one of the reasons I came was exactly what you said. My 401k money is so limited, and it's starting to frustrate me because I'm like, there's more things I'd like to be doing with my money than you're letting me do.
Yeah.
If that, so.
Yeah, and I think that's a good thing, and it's also a challenge, right? If you were to work at a company, you build up your 401k, you move on to your next opportunity, your next company, you take that 401k money and you roll it into an IRA account. I would recommend roll it into the next company's 401k, but let's say you don't. And you roll it into an IRA account. Okay, now I'm in charge of my money for my retirement, and I can make a choice. I can either continue to leave it where it is in these collection of stocks and bonds, mutual funds, ETFs. Okay, I sort of kind of know what that is. I'm kind of comfortable with that. Or I can look at and explore these alternative investments, private equity, private lending, oil and gas investment. But I don't know anything about that. Okay, good luck, right? So now I have to learn these private investments.
Right.
That's a big ask. That's hard. It is. As a professional, it's hard for me, right? There's a lot going on. But working with advisors allows for this due diligence, this conversation. And that's just happening more and more now. It's you know, the market is demanding, people are demanding access to this stuff because of what it does. Still has risks associated with it. It's not free money, but it's just that level of sophistication is becoming more commonplace. Good? Am I over time?
All right.
Thank
Thanks
you.
so much, Christian.
I appreciate it.
Okay.